This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to my channel. Markets have been recovering lately, and a lot of people's portfolios are hitting new highs, mine included. Seeing those numbers climb to a new peak, I'm not gonna lie, it feels great. So today I want to talk about the risks of covered call ETFs. I know plenty of other YouTubers have covered this topic, but I still want to share my own take on it. This is purely my personal opinion, so please think it through for yourself and make your own informed decisions. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US. It allows you to convert your distributions much more efficiently. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Mumu is excellent. Having that data organized like a digital pay stub is a massive time saver. If you're looking for a more efficient way to manage your income portfolio, Mumu is definitely a choice worth looking into. The first risk, and arguably the most fundamental one, is the risk that comes with the underlying holdings themselves. With any covered call product, you are always holding the underlying asset. The covered call strategy simply generates cash flow by selling call options, and the premiums collected help smooth out the overall volatility of your returns. But smoothing out volatility is not the same as eliminating risk. In fact, the more volatile the underlying asset of a covered call product, the higher the distribution tends to be. That means investors who are chasing those high payouts have no choice but to accept the high volatility that comes with them, and that kind of volatility requires a lot of conviction in the underlying asset to actually hold through. Once the market bounces back, it's easy for people to look back and say a certain ETF is great. Take Q-Day, for example. During the recent pullback, a lot of people were criticizing it for performing poorly, and the drawdown was pretty steep. But here's the thing, Q-Day's underlying holding, QMVP, is a highly concentrated index with only 25 holdings, made up almost entirely of high-growth tech stocks. It's even more concentrated than XLK. That kind of structure means when the market is in risk-on mode, it rips higher fast. But when the market sells off, it tends to fall harder than the Nasdaq 100. So of course it's going to come under fire when things turn south. The nearly 20% distribution looks impressive on paper, but that number is built on the back of the underlying asset's high growth potential and high volatility. Investors need to be clear-eyed about exactly what they're buying. Taking it a step further, a lot of people buy covered call ETFs with their eyes fixed on the distribution number without actually digging into what's underneath. Just because two products are both called covered call ETFs doesn't mean they carry the same risk. There's a world of difference between one backed by the S&P 500 and one backed by a handful of concentrated tech names. So whenever you're looking at a distribution rate, you need to ask yourself, what kind of risk am I actually taking on to get this payout? If the underlying drops 30%, can I hold on? That question is easy to brush aside when markets are running hot, but it's exactly the question that matters most. The second risk I want to talk about is the 25% leverage. Using 25% leverage to offset the capped upside that comes with a covered call strategy is honestly a creative idea. But there's a critical issue built into it. There's a timing gap between when the market falls and when the premium income actually comes in. A market sell-off happens immediately, but the premium collection comes later. That means when the market is in freefall, the premium income can't cushion the blow in time, and with 25% leverage amplifying the move on the downside, the drawdown ends up being even deeper. It's worth acknowledging that most of the covered call ETFs out there today were launched during a bull market. They simply haven't been stress-tested by a real downturn. Honestly, I'm genuinely curious how many of these products would hold up under 25% leverage when the market really turns against them. There's another detail worth paying attention to. Leverage isn't free. The borrowing cost directly eats into the fund's net return. In a low interest rate environment, that cost is easy to overlook. But once rates stay elevated, the financing cost becomes a constant headwind quietly dragging on performance. In other words, 25% leverage can have very different implications depending on the rate environment you're in. And a lot of these products were launched right in the middle of a period of rapid rate changes, a variable that most investors haven't fully priced into their expectations. Also, we know that in a sideways or declining market, covered call ETFs tend to outperform their underlying assets. But what we don't yet know is whether that advantage holds up under 25% leverage when the market is working against you. Now, another thing worth bringing up, In the race to offer higher distributions, more and more of the newer covered call ETFs being launched are built around highly concentrated, hand-picked portfolios. Biggie, HHIS, and YMAG are good examples. Their holdings are typically individual stocks selected by the fund manager. But just because a stock is popular right now doesn't mean it's going to be a long-term winner that leads the market forever. A highly concentrated portfolio means higher volatility, and measured against a benchmark like the S&P 500 or the NASDAQ 100, you could end up outperforming or underperforming. It really could go either way. And as it stands, Biggie, HHIS, and YMAG have not outperformed the NASDAQ 100 since their respective launches. If the concentration is index-based, that's a relatively manageable situation. But when you're dealing with a hand-picked, highly concentrated portfolio, the risks run deeper. An actively managed covered call strategy is heavily dependent on the skill and judgment of the fund manager and their team. That means you need to be constantly watching the fund's performance to see whether the manager is actually doing their job well. Index-based funds, by contrast, are far more transparent. You can directly compare the ETF's performance against its underlying index and get a clear read on how efficiently the covered call strategy is being executed. With hand-picked concentrated holdings, that kind of assessment is much harder. Take HTA as an example. If you go through its quarterly reports carefully, you'll find that there are almost always 1 or 2 stock changes every quarter. That means you'd need an enormous amount of patience to track the holdings period by period and evaluate performance at each stage. And even if you put in that effort and find that something seems off, you'd have a very hard time making a case for it, because you have no way of knowing what decisions the fund manager made behind the scenes or which specific moves affected the fund's outcome. That's exactly why I've never been comfortable holding large positions in non-index products. Even though I do hold HHIS and PayG, I've always kept those positions at a size I feel comfortable with. Alright, that covers the key risks I wanted to walk through today when it comes to covered call ETFs. After going through all of this, I want to be clear. I'm not saying these products are bad, and I'm not telling anyone to avoid them. In fact, my own portfolio right now is made up almost entirely of these kinds of products, so I'm taking on the same risks myself. What I am saying is that every investment product has its place, and covered call ETFs are no different. They can be a genuinely powerful tool for generating cash flow, but only if you actually understand what you're buying, where the distributions are coming from, how the product is likely to behave when the market turns against you, and most importantly, whether you can hold on when it draws down hard. Investing has never been about finding a perfect product and going on autopilot. It's about finding an allocation that fits your own risk tolerance and financial goals, and keeping a clear head through the inevitable ups and downs. I hope today's video gave you something useful to think about. If you have any thoughts or questions, drop them in the comments. I'd love to hear from you. And if you found this valuable, a like goes a long way and means a lot to me. See you in the next one.